Your data shows that Black fund managers are outperforming 90% of the time. Why are they outperforming the rest of fund managers so effectively? We're talking to the architect of the State of the Black Capital Report, CEO and founder Joshua Charles of Frontier Dominion, and member of the Capital Alliance Network. Joshua, how you doing?
Hey, Leroy, doing well. Excited for this conversation. We have a lot of good numbers to talk about.
We do. Man, this is a 35-page report on the state of Black capital. What was the motivation and the impetus behind curating this report?
And as we move along with this discussion, we'll really speak about the numerics of Black private equity fund managers, but we see a material significance in the outperformance of Black GPs within the private equity ecosystem. And so I think the real motivation is, hey, there are these really important numerical data points that say that people that look like you and I are actually doing very, very well in the asset management space, but people just don't know about these numbers. And so I wanted to put pen to paper and help people understand this through a compelling narrative that starts from kind of a numerical discussion, speaks about the trends in global economies from developed markets, emerging markets. We discuss the policy implications and kind of the state of the political apparatus. And then we get into some lessons learned, which hopefully readers and even listeners of this podcast take away some digestible material that they can use to drive feasible solutions forward.
So I want to start. Let's just jump right into it. I want to talk about the performance data, which as we look at the report, was anchored by proprietary data from the National Association of Investment Companies. And your research shows Black investment funds returning 16% per year compared to 9% for typical funds. And that's a huge difference. Can you explain, Josh, and every drives this outperformance?
So we see three core reasons for why Black fund managers are outperforming relative to their peers. This touches upon access to underserved or overlooked deal flow, also touches upon operational rigor born out of capital scarcity. Takes a lot of time for Black GPs to get to this position where they are architecting deal flow and supporting the acquisition of companies. And so I think from that perspective, it's, hey, there has been a level of stress testing to get to this point that has been embedded within how we even go about our due diligence, our sourcing strategy, and the like, and we just have to do good. So there's an added pressure dimension right there. And then thirdly, it's the fact that this group tends to have a unique network and insight that surfaces opportunities that others miss. And in this case, we'll get into this further, but one part is the service economy and how a lot of baby boomers are retiring in the near future and presently.
And when we talk about reports like this that tend to show, and well, in this case, Black fund managers outperforming their competitors, the question around the legitimacy of these numbers always comes to light. And so, again, your data shows that Black fund managers are outperforming 90% of the time. And again, this data comes from the National Association of Investment Companies. Can you help us understand who's included in this study? Who are the fund managers that were included in this study? And could we confidently use this data in a general sense when we're talking about the performance of Black fund managers?
This is a great question, and I think it speaks to the integrity of the data that is used in this report, as well as that was facilitated by the NAIC. And so we see that The study really leans on about 29 firms that participated in the study that is of reference within the report that my firm and I wrote. And within that representation, you have a wide size range in terms of assets under management, which ranges from 8.8 million USD to 101.8 billion assets under management. So it's not just one unicorn. It represents a wide spectrum of funds and fund managers who generally have been around the block for some time, as well as alternative fund managers who are just getting the ball started.
How many funds are we talking about that was included in this report? And in terms of the time period as well, where are we looking at the last 5 years, the last 10 years? Give us a sense of how many funds you actually looked at this report and the time period that it also covers.
So the time period is actually a pretty wide consideration. The data reference in the study is from 1998 vintage years to 2023.
Wow.
Representing vintage years. So a wide, I mean, that's roughly 25 years. In terms of the number of funds, to my understanding, more so, I think the point to look at is really the firms. Some firms may have had several funds that have their data represented in this analysis. Particularly if we're looking at the larger firms with probably net of 50 billion in assets under management. But I would say there's a considerable amount of data in terms of high quality data, and the time range tends to be pretty favorable in terms of substantiating the robustness of the data used, and not only the study facilitated through Capital Alliance Network, but also the study created by NAIC.
And real quick, because I want our audience to really understand, seems to be one of the significant drivers behind the performance of Black fund managers. And you spoke earlier that perhaps there's some unique insight into the service economy. Just really quick for us, reiterate again, is one of the most effective or important drivers behind Black fund managers outperforming their competitors.
So to really accentuate the points, I think we must look at really the operational rigor standpoint, right? I mean, as you know, Leroy, and this is why Capital Alliance Network even exists, right? It's to help increase the representation of Black GPs within this ecosystem, whether it be from an operator level, or whether it be from a fund manager perspective. And so the point that I'm getting at is, I think within these spaces, it can be quite challenging to even break through in terms of relationship dynamics, in terms of even having a clear, well-defined proof of concept, which is paramount within anything that is just being started, whether it be something that's more so in the startup ecosystem, which we're talking about now, like the founder space, or whether it be something that is more so within the fund manager space, which is just perhaps a new fund manager starting out with $10 to $20 million fund, which would probably be more so like 20 million to start off. And then from there, there's a demonstrated track record of success. But this operational rigor comes into the picture because of the scarcity when it comes to the ability to get in these circles. The culture tends to be a bit different. I think from the standpoint of the folks who represent the Black GP ecosystem, but equally so, we are well attuned to I think the culture, as some of us come from this ecosystem, or so the white collar space, but some of us are coming from a perspective where we're entering from less traditional positions, right? Where perhaps we founded a firm ourselves, and we're entering this ecosystem where, hey, we've been an operator now for 10 to 20 years. We've exited a company, sold our company to a private equity firm ourselves, and now we have some liquidity to start a fund in terms of the required setup process. And now we want to get our hands dirty and really own some assets. And that's where wealth accumulation really comes into the picture. But it all stems from, or in terms of our success, it really comes down to, hey, there can sometimes be this level of scrutiny to get into these spaces, but the numerics show that we actually do quite well
Quite well.
relative to our peers, and so we have the statistical indicators that tell us that this is the case. And as you and I know, the numbers don't lie. So sometimes it's best to lean into the numbers.
I want to talk. I want to shift to because clearly the data shows the performance at a high scale, and I want to talk about the disconnect between performance and capital assets because what tends to come up is, and I think this is what confuses folks like you and myself, or folks who may look at these numbers and say, well, they're outperforming their competitors, yet investors aren't lining up. So my question, Josh, is you note that despite this track record, Black fund managers control less than 1% of the $5.3 trillion private equity market. If these fund managers are consistently delivering better returns, why aren't investors throwing more money at them?
I believe the allocation trends comes from a few different factors, such as they're driven by institutional trust, networks, and path dependence. And so, if we look at some of the actual real time sequences of deal flow, even in terms of the deals that I get on my desk as someone who's more so in the strategic advisory investment research space, that is more so coming from relationships. And equally so for other people, this is the case. And so, how do you develop these relationships? Well, we're looking at a few different indicators. I mean, it's going to cost you, 5,000 to 10,000 bucks to go to some of these conferences, right? So just in terms of getting your foot in the door, you need to have capital ready and the willingness to spend that capital, depending on where you are in terms of, your capital stock or saving stock, right? Or starting capital. This may be more feasible to you than otherwise, but it's about working towards that to really gain access to building some of these relationships. But it's also you have to bring value to any engagement that you have. And I think as someone who's a business person myself, and there has been plenty of learning opportunities, the way I look at it is, hey, there is clearly some level of fundraising selectivity because of these indicators I mentioned, touching upon institutional trust networks and some level of path dependence. But also, you need to find a way to bring value to these institutional players in a way where either, hey, you're helping them achieve a few things. You're helping them either save money, increase their operational efficiency, or you're helping them increase their Rolodex in terms of potential capital raisers themselves or in terms of potential media spotlight. And I think for an organization like Capital Alliance Network, you all are heavy in the media side of things, and I think that sets a clear example for what others could potentially look at. Of course, you have to establish your own niche, and gain some customer loyalty or following over time if you're in the media space. But I think it all comes down to value proposition, given kind of some of the roadblocks to consider.
And you mentioned Capital Alliance Network as you're a member of Capital Alliance Network, and obviously, as you mentioned, I help support the media and the storytelling, and they're building that piece out to bring more spotlight and awareness to the performance of Black fund managers. But even on the relationship piece, as you mentioned here in your report, that fundraising selectivity and limited relationships are some of the barriers to Black fund managers getting access to more capital. I want to get your thoughts on Capital Alliance Network and their events and the way that they're approaching relationship building to help fund managers build more effective relationships in that private equity and venture capital space. What have you seen from the network in terms of their approach to relationship building?
Absolutely happy to dive into that. And here is where I think Capital Alliance Network really stands out. It's a fact, and I think generally in business, this is the procedure that you want to follow, right? You want to lean on a relationship model first, more than anything. I mean, this is a space where we're not dealing with small transactions of like 10,000, 20,000 bucks, right? We're dealing with significant transactions, multi-million dollar and even billion-dollar transactions, depending on where you are in terms of deal flow and track record of success, whereby you get access to some of these larger opportunities. But separately, I think that you have to build relationships now. You have to be active in terms of navigating this different terrain. And so even last year, I attended an event through Capital Alliance Network that was in Napa, California, where a winery was rented out, and that was a great opportunity for 30 of probably the relatively more engaged, high-performing men, a part of that network. Were able to come together, drink some nice wine, and a great terrain, great environment, but also potentially talk about deal flow, right? But the idea is, hey, we started talking many months before this. This wasn't like, hey, we're just meeting for the first time, right? It's like,
Yeah.
hey, we are coming together. We've all known each other or had discussions individually and as a collective several times, and so I think it's like that relationship building standpoint, as well as that beacon of support that comes from Can, that really stands out to me, and that's been my experience as a member so far for since its inception, essentially.
Yeah, and if I could just add to that, as you mentioned, you've seen that firsthand, and I've had the opportunity to attend several CAN events over last year, and we have one coming up next month. And one of the things that I typically hear from members of this network and those who were attending these events to just get a sense of what's going on and how they can get involved is the value that they gain through the relationships that are coming through this network. And what has been the most interesting part, Joshua, is that it doesn't take long for business and the deals to start flowing once these relationships once they start to generate these relationships and get more comfortable and familiar with each other. Because I think they all enter into this space wanting to make money, wanting to make deals. The challenge is, who are you, right? As you mentioned, these are not small transactions. These are multi-million, sometimes billion-dollar transactions. And you're not just giving that type of money away to someone you just met. But I think the power that exists in Can, as you've seen and as I've witnessed, is that because this space is specifically curated around relationships first, it tends to ease people into these relationships, allowing them to accelerate business and deal flows in a way that does not exist in other spaces, private equity and venture capital spaces. So I echo your sentiment in sense of Can seems to have a great relationship model that is quickly leading to business and deal flow. I want to talk about, in your report, you noted also that the typical Black fund manager manages about $400 million, while the biggest funds typically manage about billions. What would it realistically take, and for how long, for a fund manager with a great track record who's managing 400 million to grow to a $2 to $3 billion fund? What are the specific milestones that would matter the most as they accelerate or grow towards that $2 to $3 billion fund?
This is a great question because it starts to help our potential listeners understand what do they need to actually go from not necessarily point A, right? They've gone from to get to 400 million in assets under management. You've done some great things so far. So I want to commend those who have gotten to that point. But in terms of scalability to, let's say, go from point 20 to 100, which is the several billions in assets under management, well, one, that's going to take having a successful track record of success, probably 2 to 3 fundraisers, which can mean roughly about a decade-ish, depending on realizations and market conditions. And there are a few key milestones to keep in mind to achieve this level of success. And there are 4 that actually come to mind. The first one is landing a credible institutional anchor commitment. This is going to come from the larger LPs who have some relatively high level of reputational integrity to maintain, but also just have a good reputation over. Secondly, it's showing realizations. How has your fund performed historically? If you're on fund two, how did fund one perform? If you're on fund three, how did the first two perform? It's not just EBITDA, it's not just multiples, but it's also in terms of one's investment thesis as well as their relationships to the limited partners who deployed capital to them from the very onset. Was it a mutually beneficial marriage, you can say, in terms of a partnership that allowed potentially this pension fund, right, to which may have more exposure to public equity markets or fixed income, see some greater magnitude of returns from being invested in your fund, and hence is that something that they want to replicate through a larger fund and a larger allocative distribution to the projects that you may be involved in. Thirdly, we're looking at building institutional grade operations. This includes auditing, compliance, and reporting, meeting the standards of the industry. And presently, right now, with the advancements in technology, which I'll attribute partly and strongly to artificial intelligence, has made this process a bit more democratized than previously. And so it's how can you use the tools effectively at an institutional level to increase the performance of the companies in your portfolio, as well as cut costs efficiently in a way that generally, is in consideration of the operators, and I think the work style of many people instead of being so cookie cutter. Because I think when you focus on actually bringing value to the workers, a part of these portfolio companies, you incentivize them accordingly. This gets into kind of the management style of leadership. If you are a good manager, a good leader within the private equity ecosystem, to some extent, you may not be involved in the day to day. You may have an operating manager that is involved. However, if there's a way for you to show some level of compassion or incentivize people accordingly based on some performance metrics and bonus structures, payment structures overall, then that's where I think you can get some pretty good returns across your portfolio companies. And the last thing I'll say is, and building upon this point that I just made about the team, it's deepening the team so the platform looks more durable at scale. You want to make sure that as a fund, you have the necessary competencies on board. Not just someone who is the visionary, a part of the team, but someone who potentially has a track record of success within the operating space across whatever matches your investment thesis. So if you are someone that is specifically looking at SaaS companies, then you probably want someone who has held a leadership position within these spaces. You also want a good chief financial officer, and you also want a good chief operating officer, and then you'll want some technical people too, which touches upon thematically what is a part of one of my solutions that can be extrapolated to the asset management space overall.
You know, man, your response makes me think about a conversation I had with an investor within the Capital Alliance Network just a few weeks ago when I asked him, "What are you looking for in fund managers or even entrepreneurs in terms of investing? What are the green flags, if you will, that make you say I'm going to put my money behind this fund manager and this entrepreneur?" And he listed everything you just said. What does a track record look like? Is there consistent high performance or results? And what does the team look like? If all of these things check out, then they're more confident in putting not just their dollars, but their resources in their network, which you and I both know can be even more valuable sometimes than cutting a check. But they're more than willing to put their money, resources, and network behind this fund manager or this entrepreneur if they have a history of results and if they have a strong team behind them. Everyone has ideas. You and I both know that. But not everyone can execute consistently, and not everyone has a strong team behind them often. So thank you, man. Your response and is straight on. One of the things I did want to talk to you about, Josh, is we know there's a lot of political tension right now, particularly around diversity initiatives, with some states even passing laws that emphasize investment decisions must be purely financial. How should Black fund managers navigate this environment? Should they focus only on return numbers, or is there a way to talk about strong performance and positive impact without triggering backlash? What are your thoughts on Black fund managers navigating the political environment today as they look to raise?
This is a really important question, I think, given where we are in terms of the moment in time. So we have this data that says that we, as in Black GPs, do fairly well from a performance standpoint. And so I think it's particularly useful. It's all about narrative crafting. And so, to one point, you want to lead with objectivity, and you want to lead in the fiduciary language of returns, risk, cash flows. And while the strategy is financially sound, you want to speak to the language that objectively shows that you understand the terrain, because in the private equity ecosystem, there is such a strong leaning, I would say, beyond the relationships. It's how do you get to the institutional level? Well, you have to ignore the noise around you to some extent, and you have to be focused on performance. But there's also this larger narrative, which is where I think the media sound comes into the picture. And that is, if one is discussing impact, it should be framed as financially material, leaning on risk management, revenue durability, cost reduction. However, it's through partnerships with organizations like Capital Alliance Network that even if you are operating on an institutional level, you still have the ability to contribute to the narrative of Black GP performance. And that stems from the organizational unity that comes from like-minded individuals saying, hey, we're not just an ESG metric to cross-check on your list. The data is there, and we are there to not be simply ESG, DEI kind of highlights, but more so we're here to do business. We're here to have wins with like everyone else and with everyone else. And so I think it's having that welcoming and friendly ambiance that lets people know that we're ready to get things done is where Black managers will do quite well, in my opinion.
And on that note, man, let's talk about solutions and the implementation process to some of these specific policy recommendations that you've laid out. So your report does lay out 3 specific policy recommendations. And I want to get into the details of these and any obstacles that stand in the way. So one of your recommendations is that investment committees need people with strong math and economic backgrounds to properly evaluate fund managers. How would this actually work in practice, and what would prevent this from becoming just another hoop to jump through when it comes to identifying fund managers and something that genuinely helps identify best performers?
I think what this really comes down to is, for my graduate education, I went to the University of Chicago, Harris School of Public Policy, where they really emphasize quantitative fluency. But just given my background, I started taking, graduate courses when I was in undergrad, focus on machine learning and what have you. And so I'm not saying that to brag, but I'm saying that to speak to how that has been useful in helping me be of service and bring value within the investment ecosystem. And so the premise of this solution leans on data, and it leans on the quantitative fluency and how that can be integrated on the investment committee level, because I recognize that investment committee members and they generally have good experience within that level of the investment committee, or they perhaps rose through the ranks fairly quickly, and they have a good track record of success and institutional trust. However, I think something to keep in mind is there might be that gap, that disconnect in terms of the evolution of data itself and how that can be used in terms of narrative crafting and the likes. And so I believe that senior leadership should be able to assess portfolio theory, macro risk, and performance metrics across public and private markets. And to get this done, and to move beyond just becoming gatekeeping, it's, in my opinion, it's applying the same transparent, performance-based criteria to everyone and use quant rigor to reduce bias, not increase bureaucracy. So actually, the quantitative dimensions can help streamline the investment committee's decision-making process, whether it be on the compliance side, whether it be on the policy crafting side internally, or more so in terms of if they are representing a regulatory body as a member of a separate investment committee, contributing their perspective to a dialogue that can lead to such solutions, such as quantitative fluency on the investment committee level.
I want to talk a bit more about quantitative fluency. What does that actually mean in concrete?
Quantitative fluency in concrete terms, we're not talking about being quantitative researchers and being able to be in the quantitative trading space. I think those type of backgrounds should be represented within the investment committee level. But I think quantitative fluency comes down to being data driven and understanding and speaking the level of data analysts to some extent, not necessarily data scientists, though there should be some representation of that within the investment committee level, or the ability to actually utilize these tools. It's not just dashboards. It's attuned to the language of the investment committee and how they make decisions. And so a part of this is actually having some team members, depending on their level, support this data process that has hopefully been facilitated by or mandated by some type of policy creation process.
Your second recommendation is that institutions systematically evaluate Black fund managers in their main investment process and not as a separate diversity initiative. Again, what would this look like in practice, and how do you get a pension fund or an endowment to actually change their evaluation process?
In my opinion, I believe we really have to look at performance-based integration rather than potentially looking at the lack thereof, because the mathematical such an integration is mathematically justified. So it's actually a mathematically justified allocation decision, and it's grounded in IRR, TVPI, TPI, and comparable benchmarks that people within the private equity ecosystem need to understand, and they do understand. And so this isn't reinventing the wheel. This is actually calling for some level of refinement in that Black managers actually, Black managers can receive some level of scrutiny that perhaps exists more than other groups. And so I think it's, hey, you want to bring the scrutiny, we'll bring the data, and the data exists. So it's more so highlighting the existence of the data and telling people, right, like, this is in terms of changing conventional wisdom, and changing conventional wisdom takes time, but to change conventional wisdom, people need to kind of have some of these things put in front of them. And again, we're not saying this is from a DEI, ESG perspective, right? We have the mathematical indicators, and thus this is a mathematical justified decision process, which from a portfolio allocation standpoint should relatively increase performance and optimize any portfolio decision. And ultimately, it's a win-win situation.
And your third recommendation, I think this may be the one that's most popular with fund managers is you propose that major institutions should be willing to be anchor investors, essentially the first big check for proven Black fund managers. My question is, how do you structure these investments so they're genuinely based on performance and not seen as diversity money or charity?
I believe it comes down to structuring these first meaningful commitments in the form of first loss capital, structured seeding as appropriate where empirical evidence shows superior differentiated performance. And so essentially what you're saying is, hey, to actually, the way that this can be done in practice is similar to kind of tranche payments, which exist in the project finance space. Which is where I have some experience in. And this is where you want to actually say, okay, once you reach this milestone, then from there, you will receive this check size. So it's not, even if you have this institutional backing and this institutional name anchored into your capital structure, they may still be requiring you to reach these milestones. And so that's an exceptional form of risk aversion that ideally serves not only the limited partners well, but also the Black GPs. The Black GPs are reaching these milestones. They're showing what's already been done, where they're showing what already has evidence, and they're compounding that in a way that shows anchored capital sources that they can actually execute and perform. And that's where you start to build institutional long-standing relationships. And we're not just talking about 5 to 10 years. A typical private equity exit's going to take about 5 to 7 years. And so if we're looking at several fundraising cycles, as mentioned earlier, to go from approximately 400 million in assets under management to even 2 to 3 billion or more, it's going to take some time. We're looking at probably 2 to 3 generations, 20 to 30 years. But if you're starting a fund, generally around the age of, let's say, 40 to 50, you should be able to hit a few good swings, and from there build the institutional trust, pay it forward in a meaningful way. Also, you will eat some nice, steak and eggs and all of that, depending on whatever is your choice of flavor, because you have reached a certain EBITDA performance, your fund has X amount of multiple, and you've made a lot of people happy throughout the way.
We have 3 questions here left, Josh, and I know this next one is one that you're really excited to talk about. So let's shift over to the future outlook and the Capital Alliance Network alignment. Your report includes a forward-looking section about where the opportunities are headed: AI, infrastructure modernization, and digital assets. With these upcoming changes, artificial intelligence, quantum computing, digital currencies, infrastructure modernization, for someone running or starting a Black-led investment fund today, what specifically should they be thinking about? Where are the biggest opportunities? Where are you looking, Josh, in terms of opportunities?
In terms of opportunities, here's what I'm looking at right now, and here is what I think Black fund managers should highly scrutinize. And that comes from this modernizing core infrastructure that can be used to drive real productivity. Whether it be you're operating as a fund manager that has investments within the healthcare ecosystem, or you are within the SaaS space, or some sort of platform economy or the likes. There are many different ways to slice the coin or slice the pie within the private equity ecosystem, but fundamentally you're looking at how this technology can be used as a value creation tool to improve operations, reduce costs, and improve decision making across real economic businesses. At the same time, if we're looking at some of the larger challenges within kind of how artificial intelligence has developed, well, let's be pragmatic about the fact that this technology benefits immensely from upgrades in energy capabilities. Within the United States and many countries, they're trying to figure out right now, how do we optimize our grid? How do we optimize the energy sources we have, and how do we upgrade policy in a way that allows us to meet the energy demands of our country, whether you are in an emerging market such as Kenya, Nigeria, Vietnam, more developed economies, the United States, Germany, and the like. This fundamentally, from a nation state perspective and national interest perspective, is paramount. And so I think many Black GPs need to look at what's important from a standpoint of what is important to their country. And I think when you look at that, or when you consider investments and your decision making process from that perspective, I think that's when you can actualize sustained capital flows, continuous cash flow positively, where you break even on an investment relatively soon because you have viewed things pragmatically and are using this advanced technology to, whether it be, even blockchain technology, AI, quantum, right, to make smarter decisions and to increase your ability to meet KPIs, to drive the performance and revenue of your portfolio companies.
And we've talked a lot about the Capital Alliance Network and the work they're doing to drive more success, more opportunities for Black fund managers, including in the spaces you've just mentioned: AI, digital currency, infrastructure modernization, and etc. Capital Alliance Network has an ambitious goal. By 2055, they want to have $1 trillion under assets managed within their network. And so based on your research, Josh, what are the 2 to 3 most important things organizations like CAN need to do in the next couple of years to make real progress? When you look at CAN's 2055 goal of $1 trillion assets managed, what are the 2 to 3 things they need to do to make progress towards that goal?
It's definitely an ambitious goal, but I think, it's all about effective prioritization. And so if we're looking at 3 core priorities, this actually becomes much more feasible than what meets the eye. We're looking at these core things: building a data spine, tracking, evaluating, and showcasing performance so allocators can underwrite with confidence. So it's about being data driven. This doesn't go away just from an investment committee perspective. It's also about the fund managers, alternative fund managers, and established fund managers continuing to lean on compelling data narratives that speaks the level of institutional capital. And this isn't necessarily ingrained within everyone's mind, but certainly it's something that this is where CAN's different educational platforms, or let me say educational projects, comes into the picture. Secondly, we're looking at creating an institutional anchor pathway. And this is where an organization like Capital Alliance Network really brings values to proven managers by securing early, helping these managers secure early institutional checks that unlock scaling. So the way I look at it is, even from the standpoint of project bankability, if we are looking at a road project in West Africa, or we're looking at the Lobito corridor, which is a large-scale project that the United States and other countries have invested a tremendous amount of capital in, we're looking at project bankability from the standpoint of feasibility studies. Have these different exploration studies been done? Has work been done on the market analysis, right? Offtake agreements, depending on the project within this gamut, if it's critical minerals or what have you. And so equally so, we can look at this perspective. And to another point, has institutional capital from the form of DFIs, multilateral development banks, been inserted in these projects. So equally so, we're extrapolating that perspective into fund managers. Different ecosystems partly, but this is where Black GPs can perform, and equally so the fundamentals do not go away. And so if I'm looking at this from the perspective of having an institutional anchor, you're de-risking, right? Because if an institutional anchor is a part of the capital stack, what you're telling others is, you're vetted, you have a good reputation, you've already proven a certain level of excellence and an ability to develop and maintain relationships over time. if you're asking for money, generally it's not going to be based on you've only known someone for X amount of time, at least in terms of getting your first check as a fund manager. And so I think it's really leading into the side of getting these institutional anchors on board, showing people that you are credible. And once you show people you are credible, that's when they want to work with you. And so I liken this institutional anchor capital to what we see in emerging market infrastructure and projects, which is where we see these development finance institutions and the like invest into the capital stacks early on to de-risk. And you're also saying, hey, we have this managerial oversight to some extent from this institutional anchor source that is helping us achieve a certain level of excellence earlier on than otherwise in the absence of that anchored capital. The last thing I'll mention is you want to reduce the institutional readiness tax. So this means sharing compliance, reporting infrastructure, so fixed costs don't crush smaller funds. So you really want to manage your balance sheet pretty effectively, regardless of where you stand in the business world. If you are a smaller business, or your turnover is 5 million annually, 10 million, whatever, 100 million, etc., so on and so forth, you really want to implement institutional grade solutions and practices in your business early on, because that gives you the foundation you need to scale from not only point A to point B, but we're talking about point B, C, D, and so on and so forth. And so, to my point earlier, we talked about what does it mean to go from 400 million in assets under management to several billion, 100 billion, and more. Well, it's going to take this level of disciplined capital allocation, but also integrating institutional readiness practices and standards relating to compliance and reporting infrastructure that helps you move forward in an organized way.
My last question, Joshua. If someone listening to this interview is inspired to take action, whether they're a fund manager, an institutional investor, or someone who wants to support this proven ecosystem, what's the one thing you want them to do in the next 30 days?
In the next 30 days, I suggest the following for our listeners. If they're an investor, audit your pipeline. Look at how many top performing Black managers you actually have within whatever portfolio that you have, and evaluate how they perform. See if what is actually being stated is true, but bear in mind that there's some level of, it takes time to materialize some numerical statistics that have likely been alluded to in this discussion. Secondly, if we're looking at managers, tighten up your institutional readiness. This is going to look like catching up with things on an institutional level. Looking at the data room, audited reporting, clear value creation narratives that makes it easier for an investor to see where they can bring value, but also where they can actualize some sizable returns. And I do want to emphasize, it's kind of like a marriage, right? Sometimes an investor might not be right for you based on your investment thesis and your working style. So that's another core consideration. And then I think the last point is for ecosystem builders like that of the representatives at Capital Alliance Network, or MAIC. Build a bridge, anchor pathways, and shared infrastructure that converts performance into scale. You don't want to just be a place of convening, but you want to be a place of convening that leads to measurable outcomes that benefit all parties involved. And so I think if you consider some of the data points and some of the insights that we've touched upon in this discussion, you can begin to see that this could be the roadmap that can help you go from point A to Z, and that in complementary fashion is bringing value and positive social impact to a lot of people.
Awesome, man. Joshua Charles, the CEO and founder of Frontier Dominion, Capital Alliance Network member, and the architect of the State of the Black Capital Report. Joshua, man, we appreciate you coming on. Talk about this very important report. I think the last question is, where can people find the full report and how can they connect with you and Frontier Dominion?
So people can find the full report that will be published through Capital Alliance Network, through the Capital Alliance Network website or social media as it is released to the public, which should be in the near future. And if they want to continue the conversation with me, my firm can be reached at contact@frontierdominion.com. Our website is frontierdominion.com, or they can drop me a note on LinkedIn, which is at Joshua Charles, and we can continue the conversation.
Awesome. Awesome. Thank you, Joshua. Thank you for taking the time to join.
Thank you, Leroy.